All right, guys, let's pull our focus to what's happening over in Canada. Canadian consumer prices make biggest decline since the inception of the index. So since the invention of tracking Canadian consumer spending, it's the biggest decline. Well, people can't go out when people can't spend and people can't buy things. Obviously, it's going to make it hard. But we were already headed towards this for a long time now. We've been forecasting this on the channel for ages now. That people are house broke. People are overspenditures. People are spending more than what they make. The average Canadian, I think, is $1.69, for every $1 of disposable income, they owe $1.70, $1.80, whatever it is. It's crazy. Australia's in the same boat too. So is New Zealand. It is nuts. So how did people? Well, people have been spending a lot in the last, let's say, 10 years because of credit. People haven't been wealth building in the longest time. Back in the 60s, 70s, and 80s, and up into the early 90s, in Canada, even in the United States, wealth building was a big thing. People had savings. People had emergency safety nets. People had money when they needed it. They had savings. They had everything. But you know what? Now it's gotten to the point where everyone's debt building. And we got governments massaging people into believing that, hey, it's okay to take on debt. Older generations don't believe in debt, but younger generations are massaged and they're believed into it, and they're believed that it's a good thing. It's normal to be in debt. Well, I beg to differ. I don't believe that debt is a good thing. I think debt is basically a invisible handcuffs of modern day slavery. Anyways, Canadian consumer prices make the biggest decline. Let's see what's going on here from our friends at Better Dwelling. Published this morning, Canadians got temporary price relief, but it could be a sign of more serious issues brewing, says StatsCan. Reported one of the largest declines in history of Consumer Price Index, CPI, for March. The decline puts the index growth to one of the lowest levels in years. While low to no growth may be welcome for households, it could be an even further drag on credit growth. Inflation versus deflation. Quick review of inflation and deflation for the folks that don't use the terms daily. This is a good one. I'm happy I'm covering this. So we're going back to basics here, right? Inflation is when prices rise and is caused by an increase in demand for goods and services. So we've seen our housing markets here in Canada and the Commonwealth basically shoot up because the price of goods started skyrocketing. A lot of laundered money, $200 billion laundered through Canada from 2010 to 2011 to 2015. That's $200 billion that was counted, that they were allowed to forecast and actually let the public know. Unfortunately, they stopped there. They stopped counting what the laundered money and how much, or they stopped tracking it, for so to say, right? So that brought up housing, right? So it brought up and then increased a demand, right? And they started creating a fake demand on the housing market, saying, oh, we need to build more. But every builder was building for profit. Nobody in their right mind was building affordable housing, right? They would, if you're going to build for wealthy investors that roll in here with big bucks, right? So, So let's go over this again. Inflation and deflation. For the folks that don't use the terms daily, inflation is when the prices rise and is caused by an increase in demand of goods and services. Supply shortage. Economic booms leading to higher consumption, whatever the reason. Consumers will pay more, and inflation measures like CPI will rise. Generally, this is a good thing, as long as it's low and stable like the past few decades. Low and stable like the past few decades. But we got one problem. Wages, what you make, haven't been keeping up with inflation. So that's a huge issue. Capitalism, it works. I'm a true believer if wages keep up with inflation. Deflation occurs. Now let's talk about deflation. Deflation occurs when goods and services are in excess of supply for demand. The surplus can be because you're making more relative to demand, like computer equipment. In which case, it could be good thing or a sudden drop in demand because people can't buy things due to unemployment, which is a bad thing. If the whole index is being dragged lower, it's almost a negative event, not by itself, but due to the market mechanics that follow. This is a really good article, guys. That's why I love Better Dwelling, and I've read thousands of their articles over the years. The impact of low or no inflation on credit. As inflation drops, consumers and lenders make important moves that impact credit. Households and businesses hold on to more reserves to prepare for a downturn, leading to a further drop in demand. They also have less incentive to spend. Since they have expected more purchasing power tomorrow, this prolongs a recovery and it makes it harder for debtors to repay loans. When prices and revenues drop, lenders scrutinize borrowers further. So, when prices and revenues drop, lenders scrutinize borrowers further. After all, companies are often making fewer dollars and incomes will adjust. What about when the companies were making money hand over fist and people weren't being paid a fair wage? So incomes will adjust. Since no one wants to lend $1 to a borrower that may have a lower debt coverage soon, money becomes harder to borrow. So now if you look at your total debt service ratio from what you make now, if you're unemployed or you lost your job or whatever happened, you're starting to see the pattern here where you can't barely cover any of your expenses, well, a majority of your expenses anymore, because you don't have that income now to support your expenditures that you've already accumulated in the past. So we're not talking about going into debt going further. We're talking about debt past. Government programs can lower liquidity issues, but riskier lending dries up. That means the end of speculative investment. There you go. Riskier lender dries up. A lot of banks and huge companies and corporations were on this binge. They were on this debt binge, thinking that it's just going to keep going up. People are going to make more money, and people will be able to accommodate more debt and pay it down. But that's not the case. And more conservative lending despite cheap credit. We got lower interest rate, but they're going to tighten back on lending. That's a danger sign right there. When they lower rates, and they're probably going to go into negative territory. Canada's CPI makes biggest single month decline since 2006. Canada's CPI is making a historic move lower, with nothing like this seen in more than a decade. March CPI slowed from 2.2% to just 0.9% compared to 12 months ago. The last time a declaration like this occurred was in September 2006, when it dropped from 2.2% to 0.7%. Prior to the decline was made in April 2003, when the CPI dropped to 4.2 to 2.9% due to the Iraq war, leading to lower oil prices. You guys remember that, right? Canadian CPI makes biggest drop since 2006. Here it is. There's your elephant trunk. I call it an elephant trunk. There's your elephant head, the brain, and there you go. Boom. There goes the trunk in water. It's almost in the water. So the water would be this right here, 0. I see it as the elephant trunk going into the water. So it's headed towards water. And you go back to 2008, 2009, we obviously see the economic collapse there taking place. The graph doesn't lie. It's right there, right? Seasonally adjusted. Canada hasn't recorded this before. So now we're going back on track saying, wow, this has never happened before. What do we do now? We've created this massive Frankenstein monster of over proportionately valuing our homes, over proportionally valuing our fuel, over proportionally devaluing our wages because they're not adding up to what things cost. And now we created this huge Frankenstein monster at what cost? Well, on a seasonally adjusted basis, CPI made an unprecedented move. Last month, CPI fell 0.9% in March when seasonally adjusted. Excluding food and energy, it increased just 0.1%. If we exclude everything, it's unchanged. StatsCan said a decline on the size has not occurred in the history of the CPI index going back to 1992. CPI's growth deceleration is almost entirely due to the basket component. Okay. The majority, 6 out of 8 major components actually saw increases. Shelter is a big one, actually up 1.9% from last year. Sustainable in contrast. The declaration was almost entirely due to falling energy prices, which can be looked at in one of two ways. You either think it's temporary, global energy prices will be restored, and nothing else will be impacted, or other areas have yet to be impacted by the largest unemployment event in Canadian history. So now we are lagging anywhere from 3 to 6 months behind what's happening now. So there's a huge lag in repercussions, right? So this is by, who wrote this? I think it's at the bottom here. Guys, check out Better Dwelling. They're really good. By Stephen Panwasi, co-founder and chief data nerd at Better Dwelling, named top influencer in the finance and risk by Thomas Routers. Nice. Thank you so much for sharing this with us, and that allows me to share it with our audience here. Guys, thanks for being part of the channel. Don't forget to subscribe. Guys, also set your reminders here if you can for Mike in the Night, the riddle. Set your reminders. Call into the show. Tell us what this riddle is. How do we unravel this riddle? We need to find answers. Call into the show this Saturday night at 8 p.m. Pacific time. Thanks for watching, guys. Big hug to everybody. And thanks for everyone on the that support the channel in every way possible. Thank you.